The Canadian dollar, also known as the loonie, has recently hit a low not seen in over 4 years, trading at just below 72 cents USD. This drop is attributed to a combination of factors, including Canada's slower economic growth, interest rate cuts from the Bank of Canada, fluctuating energy prices, and political uncertainties. This situation affects both individuals and businesses across Canada in significant ways, so understanding what's driving the decline and its broader implications is crucial for Canadians. The primary driver behind the Canadian dollar's drop is the divergent economic outlook between Canada and the U.S. The Bank of Canada recently cut its key interest rate by 0.5 percentage point to 3.75% in an effort to stimulate the economy. However, the Canadian economy is showing signs of slowing, prompting this move to prevent a deeper downturn. In contrast, the U.S. economy remains resilient, and the Federal Reserve has not faced similar pressure to lower rates. Higher interest rates tend to make a country's currency more attractive, as investors get better returns. So, while the U.S. dollar stays strong, the loonie weakens, creating a significant gap between the two currencies. This exchange rate has mixed implications. On one hand, industries such as tourism and exports stand to benefit, as the lower dollar can attract more American visitors to Canada, who can stretch their spending further here. Canadian businesses in sectors like oil, gas, and manufacturing also stand to gain as their products become cheaper for international buyers. For companies on the TSX, a weaker dollar could potentially increase earnings, as many Canadian firms earn revenue in US dollars, translating to higher profits when converted back to Canadian currency. However, there are also downsides, especially for Canadians who travel to the US or purchase goods in US dollars. As the dollar weakens, Canadians pay more when buying American products, whether it's retail goods, technology, or even business equipment. This is a challenge for companies dependent on imported goods to remain competitive and efficient, as costs for machinery, equipment, and IT solutions rise with a lower exchange rate. Canadian companies already facing productivity challenges could find it even harder to upgrade with the necessary technology and equipment that often comes from the U.S. Oil prices too have dipped, falling below $70 USD per barrel, further weighing on the loonie. With energy being a significant export for Canada, any drop in oil prices has a direct impact on the economy and on currency strength. Additionally, the political landscape, especially trade relations with the USLS, introduces added uncertainty. Some speculate that a Trump re-election could impact Canadian trade policy and energy exports, placing additional pressure on the loonie. Looking forward, analysts remain somewhat pessimistic about the loonie's immediate future. There's a possibility it could test lows seen in past downturns, around 68 cents USD, if current trends persist. While some anticipate a gradual recovery next year, expectations have recently been lowered. The Bank of Canada's policy approach will likely continue to influence the loonie's trajectory, as it considers further interest rate cuts to stimulate the Canadian economy. For Canadians, the loonie's dip brings both opportunities and challenges. While some industries and export sectors might see a boost, individuals and businesses relying on U.S. imports or international travel will likely feel the pinch. Stay subscribed for more videos.